Yields have fallen to multi-month lows, yet inflation fears still persist. What is the ultimate store of value? We're here to have this debate, or discussion rather, with David Barse, CEO of XOUT Capital. David is a proponent of taking out the loser stocks rather than picking winners. It's a strategy that's worked out very well for him so far. David, welcome back.
David, so nice to be here. Thanks again for having me on your show.
Always a pleasure, David. And we're here to talk about your investment philosophy. I love bringing you back because you have very unique perspectives on how to position your stocks, how to position your portfolios, and how to invest basically your money. And you have perspectives that other people may not share. Let's put it that way. But it makes you unique. Your fund, XOUT Capital, your XOUT ETF, we'll be talking about that. That has a very unique strategy. We'll be talking about your current allocation and your portfolio. But first, a macro outlook. As I stated earlier, yields have fallen to multi-month lows, obviously still much higher than last year's, but we're on a downward trajectory, that's clear. Is there an inverse relationship usually between rates and stocks? And if there is, does that mean you can expect the equities markets to continue rallying?
Yeah, look, my view on this is there is a relationship, but the relationship, I think, is not founded on fundamentals and what's driving what we do and the marketplace at which I focus on, which is large cap US listed public equities. There has been what I'd call a deflation in innovation or technology. And that deflation was related or correlated to inflation risk. So as fears of inflation and the spike in rates that we had earlier in this year started to occur, folks ran away from technology disruptors or technology stocks. And I think that inverse relationship, if you will, wasn't founded on fundamentals. And so we've seen a real strong reversal of that now as rates have, as you said, come to the multi-month low. So I continue to do what we do. We keep focusing on fundamentals. We believe that it is easier to exclude losers than pick winners, but the winners are taking care of themselves, as we're seeing every day in the market right now. And that will continue.
Okay, well, let's just get down to it, David. Are we going to have a broad market crash anytime soon? By anytime soon, I mean before the end of the year.
Yeah, let me disappoint your viewers, because this is maybe the third time I've had the opportunity to answer that question. And
I'm going to ask this every single time because that's what people want to know.
You're likely to get the same answer from me, because I just believe that unless there is another unforeseen event, like a virus that spreads across the globe or some kind of disaster occurring, there is not going to be the market crash that folks are looking for or calling for, because fundamentals continue to be strong and the macro environment is continuing to provide stimulus for growth. So those companies that are growing will grow faster, and those companies that are failing to achieve growth for whatever reason, or because the business line that they're in is different, like for us, companies in the utility or energy space that are going to have a hard time continuing to grow, but companies in the technology and financial space are going to continue to grow. So I do not see anywhere out in the near term or even reasonable midterm a stock market crash like some of the others who I've addressed on your show in the past have called for. It just seems completely irrational to me.
Yeah, I think when people talk about a crash, they're talking about a double-digit correction. I mean, a single-digit correction on a weekly basis is possible, right?
For sure. I mean, markets are volatile. They gyrate. There are reasons, all kinds of reasons. We were talking a little bit before about what's happening today in a newly listed Chinese equity, Didi, and that's a pretty substantial dip in a single stock.
Sure.
But it's a regulatory caused phenomena, and unless we believe there's going to be substantial regulatory change that's going to impact a lot of the mega technology companies that are driving broad market performance, I just don't see it happening.
Let me just state for the record that you have been right before on your calls, that you've been basically telling us since last summer, that the stocks would continue rallying. And if you actually look at the S&P 500 index since the trough in March 2020, we're up basically almost 100%. And so you did make the correct call. Now, where market bears would disagree with you, or on one of the points, is that the economy still does not reflect fundamentally where the stock market has headed. And so how do you justify valuations at these levels or continuing growth if you were to take the view that the economy is still in shambles and inflation is going to be a concern?
Yeah, I mean, again, you're taking periods of time and measuring them from troughs to peaks, right? If we go back to early February, before the pandemic impacted the markets, you have a very different, if you will, performance rate, right? We're above February peak, but not by as much as that. So when you take a 100% number, yes, it was against a low that was impacted by a specific event, and we saw what businesses were able to do, how they responded to it. And again, for me and my business, we are merely selecting which companies not to own, and we let the winners take care of themselves. So it's so much easier to exclude losers than pick winners. And that approach has resulted in significant outperformance over the S&P, which is something we like to compare ourselves to, over the last year. Substantial outperformance.
What about inflation fears? 5% inflation is the last reading. Are you concerned that this is going to wipe out wealth for a lot of people?
No, I mean, you have to have some level of confidence in the people who are responsible for managing monetary and fiscal policy. They've laid the groundwork, set the stage for what their prognosis is, how they're going to manage it. They talk about a 2% inflation target. They're going to manage to a 2% inflation target. And every day, all day, people want to, cut their knees off and cut their legs off from under their knees. And yet they've proven to be a stable and, I think, very thoughtful fiduciaries, if you will, for the market. And so I just don't think that they're that wrong. And if they were that wrong, we would have felt it by now. But this has been going on for years. And I feel confident in those entrusted with making the decisions to manage that kind of risk.
Let me just go back to your macro thesis before we move on now, David. You mentioned that fundamentals are strong. And again, market bears would challenge that thesis by stating that, look, we're still not out of the pandemic completely for most parts of the world. There are still travel restrictions, like you said. Small businesses are still under lockdown in many parts of the world. And if you look at the growth side, some of the earnings expectations are not that high for stocks. And corporate taxes are another issue. The Biden administration wants to raise taxes on individuals earning $400,000 or more. He wants to raise corporate taxes. He wants to raise capital gains taxes. The G7 now has an agreement to look into a minimum 50% corporate tax. And so all these issues compound to be quite bearish for equity investors. How would you respond to that?
Yeah, look, I think, again, those are all right in front of our faces. They are known. These are not unknowns. And yet the markets continue to thrive. And I think we're going to see in the next couple of weeks, as companies begin to report their second quarter results, how phenomenally these businesses have performed. The good businesses, the high growth businesses are going to continue, in my opinion, to report accelerating growth. And what are we measuring that? The same thing you just did to me. Oh, you're up 100% from last year. Guess what these folks are going to talk about? They're going to talk about the performance of companies versus this same quarter last year. And what do you think the numbers were this same quarter last year? They were the worst. And so compare that to today, what they've done, you're going to see some phenomenal numbers. And I think those fundamental pieces of information are going to continue to drive markets forward, and for good reason, not because of speculation or unknowns. Good reason. So everything is in front of our faces. We know about all the risks you've described, and yet companies' fundamental performance, I think, is going to be phenomenal.
So valuations were due to fundamental performance, not because the Fed has printed trillions of dollars and injected liquidity into the monetary system.
I'm not going to completely duck that. I mean, there's been stimulus. And so how many viewers, how many folks like me have you had on the shows have talked about don't fight the Fed, right? I mean, the stimulus has continued to support and help the markets. And they've talked about their timeline for when they're going to start to wind that down. We know about these things. These are not unknowns. So, yeah, that's what's going to continue to occur. And that stimulus helps until we don't need it anymore. And I think as businesses continue to mature and perform, equities are really the only place to be as you look out over the longer term. So I'm going to advocate for them against all your viewers' wishes.
Well, let's talk about some of your preferred sectors in just a bit. But first, the Federal Reserve, you mentioned stimulus, of course. Can it stop? Do you think they will reverse course? Do you think they could start tapering anytime soon?
Well, they've talked about their plan for tapering, but it sounds like it's not happening for a couple more years. So, again, I don't think they do bait and switches. I think they learned a very valuable lesson from history about baiting and switching. And I think they give us as much transparency into their thinking, which is based on data, right? They're very data driven in their work. And so I do not think there's going to be any surprises coming out of the Fed unless something surprising happens in the world. And again, I can't predict against that, just as I couldn't predict that there would be a pandemic.
All right. Well, 4,300 points is where the S&P 500 is at right now today as we speak. Do you think 5,000 is out of reach by the end of the year?
You know, I'm not
asking you to put a number on it.
I don't have a crystal ball. I just think it's going to continue to grow. I do know this is a good opportunity for me to remind your viewers that the last time I was on the show, I said higher than 4163 or something like that. So we're well on our way to a successful prediction, and that's about as far as I'm going to go because I really don't have any clue about what's likely to happen. I just, again, focus on fundamentals and excluding the companies that I think are going to get disrupted. And we've done a pretty good job at that so far in our short tenure. I mean, we're not even 2 years old yet.
Yeah. Well, your fund does have a strategy of excluding the losers. Can you give us a bit of an overview of some of these stocks that you think are losers and some of the stocks that you think are fundamentally going to outperform? You use the word phenomenal in terms of describing their next numbers. Can you just give us an overview, please?
Yeah, I mean, look, if you just take the large cap names that are a part of every large cap US equity index, and AT&T and Verizon and Exxon and Chevron, these are large cap companies, notwithstanding in the case of energy businesses, what's happened in the commodity price recently, that have just had challenges in their growth. And it's growth that drives performance, and just being an undervalued security, which it was last year and was able to rebound in its price, but still well below what it had been years ago. You've got an opportunity to substantially outperform those broad indices where you own these securities in their pro rata percentage weightings. And we just focus on not owning them. So those are, very obvious ones. A less obvious one is something like Visa, which in and of itself is a technology business in the payment space, obviously, but they're having their business picked on and disrupted by a lot of the new technology upstarts in the payment space. And so Visa scores very poorly in our model and has been consistently excluded. And it's a top 10, if you will, maybe top 12 market cap company in the S&P right now. So again, by not owning that company, we've done well because it has not performed so well of recent time. So that's what we focus on. We just try and eliminate these companies from our portfolio, and then we let the other companies that everyone wants to talk about, the FANG stocks, take care of themselves. And by just doing that, as I've said, we've created in excess of 1,000 basis points of outperformance over the S&P in this last year. And that's kind of insane if you think about it, to be able to outperform by that margin. And again, it's an ETF. It's a low-cost way of gaining substantial outperformance that I think otherwise would be very hard to come by unless you're choosing a very successful track record with a very successful track record hedge fund manager who's figured out a way to do that.
Well, congrats, David. We'll have you on again soon to talk about earnings for the next quarter. But just to point out your fund now, you are tech heavy. I know you don't like to market yourself as a tech fund, but the tech stocks you have are high beta, of course. So during a market bull, it's likely you will outperform. But what happens? What if the market takes a downturn? Do you have any hedging in place?
Yeah, let me point out that what happened during the February and March crash, if you will, of last year, right, because of the pandemic, we actually outperformed in the downturn. So the stocks in that time frame that were the, if you will, disruptees, the value names, if you will, lagged before and lagged during. So they go down worse, they stay down longer. And it was only after we started this so-called recovery trade that many of those securities began to recover. But during that downturn, during that drawdown, if you will, in the market, we actually outperformed by almost 300 basis points. So again, excluding the underwhelming, the non-growth companies, the companies that are being disrupted, it's a simpler and I'd argue safer way of outperforming the broad market.
Okay, finally, let's move on to your favorite topic, gold. I say that tongue in cheek because I know you don't like gold, just to stay for the record. But you know who else doesn't like gold is Goldman Sachs. They issued a report recently that said that basically gold is not or no longer a store of value. I'm just going to quote part of their report here. They said that we recommend against an allocation to gold, oil, or commodities in aggregate, showing that they were not an inflation hedge and that gold was not a store of value. The S&P 500 index has outperformed gold by 327 percentage points, or 10.7 percentage points annualized over the last 11.5 years. So
I should use that as my marketing literature. It sounds like a perfect statement. I agree 100% with what they said.
Okay, all right, so you agree. So gold is not a store of value. What should be a better store of value then? Besides stocks, besides broad market index, what do you think about cryptos? If you were to choose between gold and cryptos as a store of value?
It would be crypto 10 out of 10 times. And I do think that for those who are looking to allocate a percentage of their portfolio to something other than stocks or fixed income securities, an alternative like cryptocurrency is a far greater opportunity, in my opinion, to obtain some store of value and potential enhanced portfolio returns than owning gold. Owning gold, to me, is something I've never, quite frankly, understood. And you have to be a doomer gloomer to want to do that. And it's very hard for someone who lives their lives optimistically about the future.
What if I told you that if I allocated part of my portfolio, not like a lot, maybe 5-8%, because gold, if you look at gold's history in relation to stocks, they have a very low correlation to each other. So it could be seen as a diversifier. Wouldn't that maybe increase your Sharpe ratio if you were to lower volatility with something that has no correlation? Wouldn't that be one argument for holding gold?
it would certainly be an argument, but I'd tell you that you could use that same argument for the many cryptocurrencies that are getting developed and choose one, two, or three of the new cryptos getting created and getting, if you will, allocations in a broader spectrum now. There are institutions that are almost now required to have exposure to these kinds of instruments, if you will. I think they're technically referred to as property, but you're going to have an allocation to them if you want to stay in the game. And so right now the allocation is small. It's got to grow. And I'd say the better number is 2%, not 5 to 8. But for your viewers, they probably cringe even at that smaller number.
Okay, well, cringe or no cringe, I thank you so much for coming on today. I'm looking forward to getting more of your feedback later on towards the end of the year as market action develops. Thank you so much for coming on.
David, it's always a pleasure, and I really appreciate it. Thank you.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe on YouTube and follow me on Twitter, DavidLin_TV.